Tsakos Energy Navigation is an operator of a modern fleet of tanker vessels. The continuous rise in global oil demand fueled by Asia, as well as the redistribution of trade routes that followed Russia's invasion of the Ukraine and the attacks on trade ships from the Houthis, can benefit this company in particular. Its strength also shows in the dividend payments that the company could more than double each year since 2021. But will this growth continue? And what about the long-term outlook of the company? Well, in today's video I'll break it down. I look at the business model and the markets of Tsakos, analyze their mode by doing a Porter's 5 forces analysis, and look at their latest financial statements. I'll also check the valuation to see if now is a good time to buy. So sit back, relax, and let's explore Tsakos' investment potential together. My name is Florian, and I use my background as a physics engineer to provide a more scientifically inspired stock analysis on this channel. Before we dive into the nitty-gritty of things, let's have a look at the fact sheet first. The ticker symbol of Tsakos is 10 and they are listed on the New York Stock Exchange. They are working in the transportation sector and were founded in 1993. At the moment, they have around 34,000 employees and their headquarters is in Athens, Greece. The market cap sits at $830 million at the moment. Tsakos owns a fleet of 66 modern vessels, including crude oil, LNG, shuttle and product tankers. This diverse fleet attracts a customer base of international oil companies, oil traders and even states. The fleet includes various tanker sizes such as Suezmax, Panamax or VLC, allowing them to navigate different global trade routes effectively. The company puts a huge focus on maintaining high safety standards and sticking to the latest environmental regulations. In addition to their commitment to safety and the environment, Tsakos also invests in advanced technology and continuous fleet upgrades. These investments not only enhance their operational efficiency and reduce the costs of their customers, but also reduce the carbon footprint from their operations. The long-term partnerships with their customers, which often involves multi-year contracts, highlight the company's reputation for reliability, quality and consistent performance. These customers include basically all major oil companies like Total Energies, ExxonMobil or Equinor. A significant portion of their revenue, 22%, is coming from the biggest customer, and their top 3 charterers make up even 41% of their revenue. 82% of their ships are currently in secured contracts, which makes the revenue quite predictable. And even though Tsakos is not naming these customers, we can deduce at least their biggest customer from the last quarterly report, and from what I found, it is Equinor. The overall strategy of the company is to fully cover all their expenses with these long-term charter contracts. Spot contracts come on top of this and have an impact of only under 3% in annual EPS. To keep the customers happy, the company is investing heavily in the growth and the renewal of their fleet. Since January last year, they have decommissioned or sold 13 older vessels and acquired 21 new vessels, with 7 of them still being under construction. These vessels under construction shall be delivered until the beginning of 2026 and will increase the deadweight tonnage, or in standard terms, the capacity of the company, by further 8.5 million deadweight tons. In addition to these new ships, further 8 ships were under scheduled maintenance in Q1. These renewal efforts bring the average age of Tsakos ships to 7.5 years, which is quite a bit younger than the market average of 10 years for tankers. This age gap is essential, and we'll understand why in just a second when we look at the latest shipbuilding trends. But first, I'd like to check if there is even demand for such tankers in the future. Overall, an estimated 80% of all goods are carried by sea, and the IEA, International Energy Agency, predicts that the global demand for oil and oil products will still increase over the next 2 years. But more than any other segment in the maritime industry, the tanker market is significantly influenced by global geopolitical and economic trends. So there is always the risk of a quick change, and the strength of today's market can be traced back to the start of the Ukraine conflict. Western sanctions have forced many big buyers to source their oil from different locations, leading to more sea trade and longer routes, and in the end, higher freight rates for tankers. And all this comes at a time at which the global fleet is aging, and in fact, on average 42% of the worldwide tanker fleet is over 15 years old. The current order book, on the other hand, is with only 577 tankers, only 10%, and this is quite low. 893, or almost 16% of the fleet, are even over 20 years old. And this comes at a time where most of the major oil companies are putting an age limit on the vessels they will use. Usually, this is around 15 to 20 years. And while safety also plays a small role here, the main reason for this is actually that older vessels are just much less efficient than newer ones, which also means more emissions and higher costs, especially in the current regulatory environment. So newer ships have a competitive advantage compared to older ones, and the older vessels also need to be replaced in the coming years. But this is not happening. Last year, the orders for tankers were quite low and only made up a very small percentage of the total orders. And it doesn't help that the numbers of shipyards is constantly going down. In 2022, there were about 300 shipyards worldwide, which fell from 700 shipyards back in 2007. At its peak in 2010, the global shipbuilding industry built a total of 2,700 vessels per year. But it is expected that until 2050, over 3,500 ships are needed to be built or refitted each year. This leaves a huge gap between supply and demand. But what is Tsakos' position in this dynamic market? Let's try to find this out by analyzing their strategic position. First of all, I would estimate the threat of new entrants as low. The shipping industry is very capital intensive and requires huge investments. Many stringent international regulations and environmental standards also create quite a high barrier to enter this market. The threat of substitutes I would estimate is medium to low. Over the long term, the shift to renewable energy sources can hinder the demand for oil transport and poses a threat to TEN. But in the short run, the aging global fleet of tankers can't compete with Tsakos' modern fleet, and the only other alternative for oil transport are pipelines, and they lack the flexibility and the reach of transportation by ship. The competitive rivalry, on the other hand, I would estimate is quite high. The shipping industry is highly competitive with many players, both large and small. These companies compete for long-term contracts, spot market business and shipping routes. Companies like Tsakos, with a modern fleet that can fulfill the latest regulations and environmental standards and have highly efficient ships, can definitely get an advantage here. The bargaining power of the customers I would estimate as medium to high. The cyclical nature of the shipping industry and the size of Tsakos customers gives them quite some bargaining power. The only reason I put this to medium to high and not to full high is the fact that the young and modern fleet of Tsakos can mitigate some of this power by offering high safety standards and emission standards. The bargaining power of their suppliers I would also estimate as medium to high. The company is dependent on a limited number of shipbuilders that can build the large and modern vessels that they require. This gives these suppliers a great bargaining position. Fuel is also a major cost factor for these shipping companies. But due to its size and the needed volume, TEN has a good position here to negotiate. So overall, Tsakos operates in a highly competitive and regulated environment. While the threat of new entrants is low, the bargaining power of their suppliers and buyers, as well as the intense industry rivalry, all poses significant challenges. But the new and modern fleet helps them to differentiate themselves, at least temporarily, from their competitors. The long lead time for new ships helps that it will stay this way, at least for the next couple of years. So let's jump into the financial details of the company now. And from a total performance point of view, Tsakos could outperform the S&P 500 by almost double last year. Over the last 5 years, both did produce very similar results, with the S&P 500 being a bit ahead as of today. But over the last 10 years, the picture changes. Here, the S&P 500 could outperform 10, and investors in the company did barely see any returns over this time frame. The fundamentals of the company are all over the place. While we can see a general increase in revenue as well as operating cash flow here in blue, the free cash flow here the yellow line, as well as the earnings per share, have a very high fluctuation and don't show a clear trend. But this is a bit deceptive because it also includes impairment charges in case the value of their vessels need to be written down based on new evaluations in case of damage on the ship or if the market for such ships changes. In 2021, for example, there were significant impairment charges related to 7 of their vessels, which totaled to over $86 million. So in this case, I think that the revenue generated from voyages is a better indicator to show how their business is going, and this shows a general uptrend. The revenue was actually growing with a CAGR of 8.5% over the last 5 years. Because of this choppy growth, the margins of the company are also fluctuating like crazy. At the moment, though, they have one of the higher margins in the market. Over the last years, the company did also manage to lower the debt steadily, and with a net debt to EBITDA ratio of 3, they can just barely fulfill my minimum criteria for my investments. Tsakos is also paying a dividend, and the current dividend payments are covered by the free cash flow. But we just need to go back 1 year to see that this is not always the case, and there have been several years where the dividend was not covered. Instead, the company did issue new shares to cover their debt and dividend repayments. In the last 5 years, the company did issue an average of 11% of new shares each year. In their most recent earnings call, they emphasized that their primary focus moving forward will be to first reduce their debt and second, to pay and increase their regular dividends. They also believe that their fleet renewal will have a significant positive effect on their operations. But in the first quarter of 2024, the trend was actually the other way around, as the EBITDA of the company did decline by around 30% compared to the first quarter last year. This is due to a lower utilization of their vessels in Q1. And even though this sounds very bad, it really isn't. At the moment, there are 8 vessels under scheduled maintenance, and they should be operational again in the second half of this year. So there are no issues with their operations, and the utilization is expected to increase again soon. So according to the company, it seems like they are getting wind in their sails again soon. But what do analysts actually think of it? The forecast for the company looks good, with the 1-year price target expecting an upside of 10 to even 45%. The earnings per share is expected to grow with a huge annual growth rate of over 21% until 2027, while at the same time, the revenue should increase with only 1.5% annually. So analysts expect that at least in the next few years, the company will produce nice returns for their shareholders. The multiples of the company are also quite low at the moment, and except the price to free cash flow multiple, they sit below their 5-year averages. Last year, the valuation was even cheaper, but it still is on quite a low level. Also interesting is that the company is currently trading way below their book value. The price to tangible book value is still under 0.5, despite it being at the highest level when compared to the last 5 years. This means that the company's tangible assets, like ships or buildings, are worth more than double than the current market value of the whole company. But we also saw before that this value can be impaired quickly and also depends on several factors like the value of second-hand ships and the costs of scrapping that the company cannot influence. So for my investments, I put a higher focus on the valuations based on the operations of the company instead of the value of their assets. Because of the choppy business and the unclear trend, I find it very hard to calculate the fair value with a reasonable certainty. So in this case, I will skip the fair value calculation and rather value the company by looking at the multiples and also compare it to their peers. We'll come to the overview of the peer group in just a bit. First though, let's also have a look at the dividends. We already saw before that the company is paying a dividend, and when measured against the trailing 12 months, the dividend yield was around 1%. On a forward-looking base, it sits at almost 4% though. This is just a bit below the 5-year averages, but we also see that the yield already went up from even lower values in 2022 and 2023. The dividend scorecard at Seeking Alpha shows an average growth rate of minus 21% per year. and that would be disastrous for dividend investors. But thankfully, it is not quite correct. What I found when I dug a bit deeper is that there was a 1-to-5 stock split in 2020. And when considering the stock split, the dividend between 2020 and 2021 did not go down. It didn't go up either, but they kept the dividend at least stable in this year. After 2021, the company did increase their dividends again significantly with a CAGR of even 145%. These dividend payments also include special dividends, but in their last earnings call, the company said that this is not so well received by analysts and they plan to include this special dividend in their second semi-annual payments from now on. Before we come to our conclusion, let's also compare 10 to their peers. And first, the total return over the last 10 years has not been very good for the whole peer group. Only Eco could outperform the market on a 10-year time frame. Tsakos' performance is actually sitting roughly in the middle of the group. From a dividend yield perspective, the company has the lowest yield from the group. The dividend growth, on the other hand, is the largest of the bunch. The valuation of the company also seems to be very cheap, not only when compared against their own history, but also compared against their peer group. PE and EV to EBITDA values are the lowest of the group, and the price to free cash flow comes in at second place right after NGL. Also interesting to see is that except Tsakos, all of these players have a price to book value that is significantly above 1. Profitability-wise, the company is also looking great compared to their peers. Together with Eco, they are leading the pack in gross profit margins, EBITDA margins, and net income margins. What is interesting to see though is that the net return on assets and the asset turnover multiples are rather low. Before we sum this up, if you liked the video so far, please smash the like button and subscribe to the channel so you don't miss out on my next detailed analysis. And now let's come back to the question, is Tsakos Energy Navigation a good investment or not? The company is a strong player in the shipping industry, and with their fairly new and modern fleet, they could win many major oil and energy companies as customers. These modern ships present quite a moat for the company, not only because the strict regulations and environmental restrictions, but mostly because they are just more efficient and can save the customers some money. The shipping and transportation business is a cyclical one, and there is always the risk of disruption in case of an accident. The financials of the company are also not what I like to see for my investments. There is no clear and steady uptrend in most of the metrics, and even though the company could lower the debt over the last years, they did it by diluting their shareholders and issuing new shares. I still think that the company can be a good speculation, specifically over the midterm in the next couple of years. And the forecast for the next 4 years also indicates quite some EPS growth. But because of the cyclical and risky nature of the business, I don't like it as a long-term investment. So I am not invested at the moment, and I also don't have any plan to invest in them. I actually think that there are even better chances with another resource. And that is coal. If you want to know why coal of all things and get some concrete stock suggestions, check out this video where I cover this underrated market. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.